advice. We have Frank Fahey on the line. I'm going to turn it over to Frank. Frank, take it away.
Thanks, Steve. Right now, can people see my screen? Do you see a full screen or just
I see your screen.
Okay, good. Well, today I'm going to talk about trading discipline once again. Last time I spoke, I was talking about discipline and the Greeks as a whole. What's very important to me is volatility. And we do have a Greek associated with that, is Vega. But when it comes to volatility, I never made money until I understood, number one, the Greek volatility. Number two, I understood the different types of volatility they are. People will say volatility and mean many different things. Okay? So first, we're going to have a trying to get this. Okay, our hypothetical performance disclaimer. Anything I show you is for teaching purposes only. We can start there. Do not go and trade anything I use as an example. Any examples I have do not include commissions, and at times are presented in such a manner to overemphasize the point I'm trying to make.
Excuse me, Frank. Can you move your mouth closer to the mic, or is there a microphone that you can get closer to?
Yes, there is.
Yeah,
can you hear me better now?
Much better. Yeah, you were quite distant there, especially when you lowered the volume of your voice. So, yeah, that would be great if you could just put the microphone closer. That'd be awesome.
You want to start again?
No, go ahead. We're sounding better.
It's always a challenge having Frank give a speech. So, yeah, hypothetical. Anything I show you is for teaching purposes only. Here's a heavily airbrushed picture of me. If you saw me on the street, you would not recognize me, but it's a credit to modern technology. I've been doing trading options for over 30 years. The bulk of it I did as a market maker at the CBOE, and I traded wheat at the Chicago Board of Trade. The past few years, I've been trading other people's money, and I'm relatively pleased with what I'm doing. It's always a challenge to trade, but I've been in this business for 30 years. I've taught, I've worked with Discover Options and OptionVue. I'm a heavy user of the OptionVue software. It's as good as anything you can get out there for the retail trader and professional traders like me. It literally gives me everything I do need. So, one of my favorite sayings is chance favors the prepared mind. I generally know what I'm going to do with my position depending on where the market goes or if it goes. And what that allows me to do is have a Zen state of mind. I have to balance patience and panic. If I don't prepare my mind for what's going to happen in the future, I'm going to react just from the gut rather than from the brain. And that's very important. I know what I'm going to do beforehand. And even with mistakes, I generally know what I'm going to do. Classic example is if I buy something instead of sell it, or vice versa, I will immediately close that even if I have to take a loss. Because it's hard enough to make money being disciplined and doing what you want to do, let alone ending up putting on a position that you don't want to do. It's incredibly difficult. So the core of my trading is discipline and knowledge. I know what I'm trading. I understand the impact of changes in price, implied volatility, and time upon my position, and I know what I'm going to do generally. I have alternative plans for price changes, volatility changes, and time changes. So let's look at some basic facts here. All option strategy work. That is a given. The biggest problem is no one option strategy works all the time. So I've been trading the same basic strategy for about 5 years now. But the strategy as I implement it and as I trade it is different now than it was 5 years ago. It goes through a constant change. 5 years ago when I started trading this strategy, implied volatility on the SPX and E-minis was 21. I traded front months instead of, now I trade 80 days out, 85 days, 87 days out where I put it on. So it's all about price action, price of the underlying, volatility. When I say volatility, there's two sections to that. One's the implied volatility. That's refers to the options themselves. And also what we call statistical or historic volatility, which has to do with the how much the underlying moves on a percentage basis. And then there's always time, how many days till expiration. Okay, one thing that you need to learn, and I have a there's an inside wire on it, I'm pretty sure, somewhere on the Discover Options history of presentations. I have discussed margin requirements and how they impact the viability of any strategy. It behooves you as traders and as customers of a clearing firm or a trading platform to know how they are calculating your margin. It's different from company to company. And as a market maker, I never learned about that or had to worry about it. Somebody else took care of it for me. But as a trader, I truly, retail trader, I trade the same thing that you people do, just bigger number. I have to be aware of what that impact is. Constant question I ask, it's what if the price changes? What if time changes? What if implied volatility changes? What if I trade this? What if I choose these strike prices? It's a whole laundry list of what ifs. And that's part of my discipline. It's not assuming that what I've done will be a difference that makes, will work. I'm constantly asking, what if the price goes up? What if the price goes down? And so one thing, there's some options that, that people operate under, and I get it thrown out to me as facts. And I'm amazed at how often even relatively experienced traders will tell me this. And quite often it's accepted as gospel among the people that trade the same things I do. One of them is 90% of options expire worthless. Now, I, for example, as a trader, never I used to buy things for a nickel, or what we called a teeny, a 16th, before they traded a penny. And then it was, we went decimal and I could trade 5, 10, 15, 20. Now it's pennies. I cover shorts. I once lost over $100,000 by not covering a short with 3 days ago that was 30% out of the money, and there was a fake announcement. Okay, and chaos reigned, and I didn't cover it. Okay, another one is sellers are smarter than buyers. I've stood in a pit with a guy who had the exact same or exact opposite strategy that I did. I'm a premium seller. I started off as a premium buyer. I am actually a premium buyer in some other underlyings that I trade. I understand premium buying. But Johnny and I were a seller and a buyer standing right next to each other, and we both made monies. What we had in common was the discipline that we approached the game, and it is a game with complex rules. It's a game every bit as much as poker, bridge, and anything with strategies. It's a strategy-based game. Another one is a zero-sum game between buyer and seller. If I buy, then the seller loses money. That's assuming that that's all either one of us is doing. I'm a position trader. I have a complex position with hundreds, sometimes thousands of options. Generally, right around 1,000 options in my position. Well, my core position. Well, nobody else has the same position as I do. They may be trading E-mini options against an SPX position or against a portfolio. We trade options for different reasons. There's no zero-sum game between the buyer and seller. And this is one that people will disagree with me, but raw option data has sentiment. And so you'll hear people say, well, the open interest is at this strike. And I've been hearing that for, 30 years. We're going to close here because this is where the largest open interest is. Well, it's something that I find interesting. And the reason I find it interesting is because people believe it. And a lot of what we see is something becoming a self-fulfilling prophecy rather than anything else. Unwinding of positions. You'll say, well, why are we going up? Well, there's more buyers than sellers. Come on, there's a buyer and a seller. They're matched up. Otherwise, it wouldn't be going up. So that's certain things. I do not fall back on things. 90% of options expire worthless. It's probably more like 10% expire worthless. About 60% of them are actually closed. They do not end up signed, expiring at zero. People actually close them. Here is a starting discipline for Frank. Okay, I can look at risk first. I don't chase gains. When I look at a graph and a risk analysis in Thinkorswim or OptionVue or Interactive Brokers, I look to see where the risk is. I use Discover Options and OptionVue. I use OptionVue 100% to define it. I use my risk. I pair what I have, my OptionVue position or Greeks, with the risk that IB, Interactive Brokers, or Thinkorswim, or Options Express tells me I have. The one that I find over time that continually reflects what my real risk is OptionVue. But I look at risk. If I'm not in business tomorrow, I'm in trouble. Chasing gains is way too risky for me. I'm not a directional trader most of the time. I'm a range trader. So right now, our range is, now 0.4% up or down on the SPX. And so I keep that in mind, and I set up my portfolio to reflect that. Here's the options pricing model. You don't need to know it. What you do need to know is what the variables that go into a classic options pricing model. We need to know stock price, strike price of the option, and that includes put or call, interest rates, and that's a risk-free interest rate, dividends if there's a dividend, how many days expiration, and volatility. And it's like, well, what do I pick as volatility? Well, that's a pretty darn good question. Okay, and to calculate an option's theoretical value, you need the price of the underlying, which we talked, the strike price of the option, And that includes, is it a put or a call? The time until the option expires, the expiration date, the cost of money, that's interest rates less dividends, basically, and the volatility, and that equals the theoretical value of the option. This is a simpler way of looking at it than what I showed you a moment before. Now, if we go to, we also use these to compute the Greeks. Delta, which is sensitivity to movement of the underlying. Gamma, that's the sensitivity to the movement of the delta. Okay, so you could look at gamma as being how fast does delta change? Acceleration. Theta, sensitivity to time. Vega, sensitivity to implied volatility. And rho is sensitivity to interest rates. Okay. Now, this is a cheat sheet, which I have sent to all the salespeople at OptionVue. Give your salesperson a call. This will tell you what happens when stock price goes up or down. Okay. The stock price goes up, calls go down, puts go down. If a dividend is increased, calls go down, puts go up. This is interesting. Dividends are reflected in the price of puts. People tend not to understand that. I can talk about that at a different date. Strike price. So if you go up in a strike price, the price of the call goes down. You go up in a strike price, the price of the put goes down. So these become out of the money calls. And it doesn't matter if it's out of the money or in the money, but if you think of it this way, and you can see how this happens by playing with your OptionVue positions. Just manipulate the risk analysis to see what happens. Vega, volatility goes up, calls and puts go down, volatility goes down, calls and puts go down. You can look at theta and rho. Now, people they totally discount rho these days. And I don't know how much longer we will, but when I started trading, I had my risk-free interest rate was 14%, and I would pay 0.5% above that if I was borrowing money, if I bought something, and I received 80% of broker loan, which was 14%, on short stock or any credit balance I had. So 14, that'd be 80 plus 11.2% versus 14.5. Any of us could make money as owning a clearing firm back then. It was a license to steal. I only say that as a customer and because I wasn't making money. Now, the one reason we care about volatility is you can be right about direction and wrong about volatility, and your trade may not make money. We've all bought out of the money calls that have underperformed as the underlying went up. And you can be right about volatility, but wrong about direction, and you may not lose money. This is the core reason you want to start understanding volatility. And this is the implied volatility. Okay. And so in the options pricing, volatility is the only unknown for short dated options. Okay. Longer dated options out 6 months, out a year, have interest rate uncertainty. So right now we might be we know what the interest will probably be for August. We know what it is, August expiration, the 17th. When I talk expirations, I talk monthlies. I'm not going to cloud the water with weeklies, even though the same holds true. But the closer to our current time that expiration is, the volatilities, the implied volatility is the only thing we really don't know. Moving out, flex options, January of 2018, and January of 2019. We don't know what the interest rate's going to be. And that's, once again, rho taking place, affecting what we trade. So, and here, we'll show you how we come up with this implied volatility number. Remember, here on the left, on the top, we have the different variables that you would input to come up with an option fair value. Quite often we refer to this as theoretical value: price, volatility, time, strike, interest rate, and dividend. But we know all these. We know the price because it's determined via auction at the different exchanges. Volatility, we don't know. Time, that's how many days expiration. Strike, we as traders select the strike. You know, is it going to be a 50 call? Is it going to be a 45 put? Is it going to be a 60 call? Is it going to be a combination of it? We can select those, okay? Interest rate, we know what that is. I use, you know, what money costs me if I'm borrowing it. And dividends, we know. So what happens is you have 5 of the 6 variables you need, but we have an actual option price as determined through the auction process on the exchange. And this is standard for all the different models, whether it's Black-Scholes, Yates, whatever you happen to use. So we flip-flop with the throw the actual option price into the equation and move volatility to the other side, and we solve for volatility. That volatility is called implied volatility because it's implied by these other 5 variables plus the actual option price. Now, this is very important that you start getting a sense for what volatility is. And so remember, volatility is probably best viewed as being a measurement of the extrinsic value of any option. Quite often that's called time value. Extrinsic is a better term because it's only time value if you look at it being parity, not parity, and not zero. And so if you have a $50 stock and a 50 call, you could have that 50 call trade, you know, across 5 stocks with the price of $50, and it could be $1, $2, $3, $4, or $5. All of them people would call time value, but it's actually extrinsic value, meaning outside of the real value as based on the price of the stock. And the stock, the $5, $50 call has a much higher implied volatility than the $1.50 call. And that's what we have to start looking at. Now, with all these, I can come up with my Greeks, which I use for risk analysis, my delta, gamma, theta, vega, and rho. I'm the last person that looks at rho, and I do that basically as a discipline going back 30 years ago when the interest rates were so high. But I sit there and I look at my position based on this, and I look at it based the Greeks over price and time, and I can manipulate implied volatility. At the end of every day, when I look at my P&L and throughout the day, I look at how much of that P&L is the result of volatility going up or down, how much of it is based on delta and gamma, which reflect what the options did in relation to the price of the underlying, and how much of that is based on theta or time. The Greeks, and once again we're going to go through it. Delta, anticipated price move, and an option price for a $1 move in stock. You start here, okay? Theta, so I look at delta and gamma, theta, and vega, trying to figure out where my profit or loss came from. Quite often, since volatility, implied volatility can be ephemeral, meaning it's a reaction to a quick move on in the price of a quick move up could decrease volatility. A quick move down can increase volatility. Okay, but I look at that and I go, okay, where did I make or lose my money? And that is how I truly learned the impact of change in the price of the underlying, change in time, and change in implied volatility affected my stock, my options position. And it's an exercise that many people don't do. Trust me, if I think my delta was X at the beginning of the day, 100 at the beginning of the day, and 200 at the end of the day because I was long gamma, I will assume, and I'll take the average of the two at 150 and multiply it by how much the stock moved. This is ballparking. Much of what we do in options is estimating, a reasonable estimate. I don't need to go to 4 decimal points when I'm estimating the profit. You know, it helps. It's a discipline that will be a difference that makes a difference. Okay, price moving. Understand that price movement of an option exists in a dynamic environment. Sounds silly saying that today when we've gone through nearly 3 weeks of minimal price change. We broke a 13-day trading streak where it did move more than 0.3% in either direction. Geez, now we can make it 14 days for sure where it did move 0.4%. I mean, I'm used to 1% moves or more in the SPX or the E-mini options I trade. The spider, I trade indexes. So what happens? What's price movement? Stock prices change. That's going to change it. Delta and gamma, time goes by. Theta, interest rates are adjusted. Not really. It's a difference that doesn't make a difference, but you should know that there is a Greek that shows your risk on that. And volatility increases or decreases. And that is implied volatility, increases and decreases. Okay. And once again, we have the components of options pricing. And options have value for 2 reasons. For calls, it's the time value of money. And it's basically how much does it cost to carry this option? Because I have to borrow that money. If I buy something, I could be using that money and putting it somewhere where I get, these days, 1%, okay? Less dividends, you know? So, and then for puts, it's the short stock rebate plus dividends. That's a basic concept that isn't crucial to what you're doing, but is important to be aware of. You know, you'll say, aha, this is the impact of dividends. And the probability that the price will change. Right now, over the past 2 weeks in the SPX, I'm saying, well, geez, 2.5 weeks. It's not going to change by more than 0.4%. Okay, that's a probability in my head. Okay, that's the range I'm looking at. If I'm putting on something short term, yeah, I may construct something so that I make the bulk of my money within that range. Okay. One thing, and I've alluded to before, volatility, vega, implied volatility, and price are generally inversely related. So volatility generally goes up when prices decline. Okay. It generally goes down when prices increase or go up. Hence, after 8 or 9 years of a bull market, we're hearing people saying, well, the VIX is so low. Now, the VIX, the CBOE Volatility Index, is a moving average based on S&P 500 option volatility. If you want to know the detail, you can go to cboe.com. I think I've done a presentation on the VIX before. It's things you should be aware of what it is, and it's good because it tells us what's happening. If you're going to look at the VIX, understand that there are options on the VIX, but they aren't on that cash number that we see, the VIX, that all of us have on our watch list. That options are based on a monthly future that settles with the VIX when it expires. It's long and involved, but hey, that's a measurement. The one exception to volatility and price being inversely related are in things like grains. As the price goes up in grains, volatility increases. The reason for that is these gains are truly supply and demand priced, much more so than stocks. The big difference is if a company starts running out of stock to sell, there aren't enough shares of stock, quite often they issue more shares of stock. That's one thing a company can always do. Here are the types of volatility. We have historical volatility. It's also called statistical volatility. It'll look at the behavior of the price of the underlying over a set period of times, 10 days, 30 days, 60 days. Different types of people like to look at their historical volatility. That's, and it's based, and you'll see it in standard deviations, the size of the standard deviations. There's also implied volatility, and that's reverse engineered from trading activity in the options. It's implied based on all the other variables in the pricing model. Quite often, traders will compare historical implied volatility, okay? We can look at historical volatility for information like what happens when there's earnings. Okay, on implied volatility, if we look at the historic implied volatility, you'll notice that prior to earnings, implied volatility goes up, which means options get more expensive. People will compare those and see, is volatility cheap or expensive? Right now, people are saying implied volatility is expensive in the VIX, the options were traded, compared to where the statistical volatility is now. Now, I glance at it, but I don't make decisions based on that. Right now, when we go through an extended low period like this, my mindset says, well, we're trading at 9, we're trading at 6 on the historic volatility. I know it can't go less than 0. So I have a support there as far as how low is low. We have actual volatility. It's what you see over the life of any trade you make. So if you're doing an earnings play and you take it off, do it a week before earnings and take it off right before earnings are announced, that higher implied volatility is the actual volatility that was occurring, implied volatility while you traded. And then we have our own personal. I think volatility is going to go up. I think volatility is going to go down. This is, you go through what if. Every single one of these I look at. Option allows me to look at historical implied volatility over time. Okay, it provides it to me in a chart view. Actual and personal, I look at that on a daily basis, because when I look at a matrix in OptionVue, a matrix with the prices of all the options, each one of those options has an individual implied volatility. I pay attention to that, especially on the ones that are where I have the largest position. Okay. So as traders, we always have expectations, or we wish. Option buyers and option sellers, all of us, when we start trading, will find out, trading options, what type of trader we are. Remember, are option sellers smarter than options buyers? Yeah, I'll say yes because I'm an option seller. Gosh knows I'm smart. But no, it's not. It's a different way of constructing your own risk reward comfort zone. This is all about looking at risk and keeping yourself in business and creating a strategy or a position that meets your risk reward comfort zone, where you are not panicking yourself out early, where you know what you're going to do. Okay. But bottom line, option buyers, people that buy calls and puts or net own paid out money to buy something, want volatility to increase. Option sellers want volatility contraction or for it to remain unchanged. Those are two basic things. You will, I would imagine, everybody that watches this presentation has a pretty good idea if they're an option buyer or an option seller. If you don't know, create scenarios. When I create a position, I have a scenario in my head based on how long am I going to hold this for time? What range do I think it's going to trade in? Up or down. What is my personal resistance, my personal support? And what do I think implied volatility is going to do? And I create something that I am comfortable having on, that is, as traders, we used to call getting flushed out of a position as being rat hole. And that's somewhat like we all, when we were kids, well, when I was a kid, we had what we call gophers all over the fields behind our house, and we used to pour water down one gopher hole and watch it run out the other. That's being rat holed. Those were our rodents that we did that to, and often on a position, I can get rat holed out of a position because I panic. I'm panicked out, and I don't want that to happen. So I need to develop my own risk reward comfort zone. Now, if you're starting off and you aren't sure if you're going to be an option buyer or seller, do some back trading and see which one you feel on the same stock for the same underlying for the same period of time with the same scenario. I think it's going to do this, and see where you make money. You'll soon find out if you're an option seller or buyer. Okay, here's a little game. If a stock moved 1% daily on average, okay, it would have a 16% volatility. And I used to play this game on the floor. I knew this. And it's sort of silly. But I'd say, what's the price of the stock? How much does it generally move a day? I'd say, well, I think you probably have a historic volatility around here. And they go, how do you do that? Multiply that percentage daily move times a percent. So lately, over the past 13 days, we'll call it 0.4, even though it's 0.3%. The SPX had we'll call 0.35 times 16 is 48 plus 8, and 5.6 volatility, annualized volatility. It's admittedly, we're taking a small slice. And the VIX itself has been trading on between 9.6 and 1.2. The future has been traded between 11 and 12 over that same period. But this is an example of where the historical volatility, and you compare the historical with the implied volatility, those changes. So it's a quick and dirty game I play. I'm going to take a break here and see if anybody has any questions. Any questions from anybody?
Nope, I see no one typing anything. Oh, go ahead.
No, Brian said, and this is good, long volatility strategies are typically costly to maintain over time, either in VIX futures or equity options. Do you have any preferred favorite long volatility strategies to exploit a potential increase in realized or implied volatility? Well, quite often what I'll do is I'll finance the long option, which is generally in the money or at the money. A ratio spread is one of the best ways to do that. You see people doing that right now, and the SPX. I mean, I see people selling, they'll buy a call vertical and sell a put vertical to finance the call vertical. There's a number of different ways that people are doing that. You can see that on CBOE. They have the group one DPM, the trader running the DPM, that's a designated primary market maker. And the designated primary market maker for the VIX is group one. And at times they or Russell Rhodes will have a video telling you large trades that have gone on in the VIX. And it's interesting. But I have a tendency, and unless you really understand the VIX, you probably shouldn't trade it. But I know people that trade the long side of the VIX and use the decay on the futures to control that decay. They use the VIX future as a hedge to the upside and downside. It's basically what you call back spreading. I started off as a back spreader because it was easier to do. In other words, I was long premium and I bought stock or sold stock against my position. And yeah, it is expensive. A common mistake too that people make on buying options is when those options decay, quite often they'll say, well, time is killing me. Time is basically a constant, and it accelerates that theta position. What really kills a trader is volatility, and it's crucial for any trader to be able to differentiate between the impact of theta, paying to own a position, that you bought, versus the volatility, the cost of volatility as the price of the option decreases, or as the volatility decreases. The other question that was asked was, how do I calculate the 16% for a 1% move? That was something that was taught to me. And over time, I realized that it's a nice little rule of thumb, John. I wonder where this is trading. So you can pull up a chart and you'll go, oh, it looks like it moves $8 a day, and it's a $200, it's a $800 stock. Well, that's 1%. If it moves on average that's times 16. It just works out that way over time. Okay. This is a great question. And somebody said, is it because 16 is the square root of the number of days in the trading year? Ha! So and Brian brings up the square root of 202 trading days in a year is 15.87. So I would say that's right. Somebody taught me that. I found it to be a rule of thumb. This is another example of how we estimate at times. It's very easy for a trader to be distracted by all the information we have coming in. What's important for us is to reduce things to the lowest common denominator. But OptionVue does some of that for me, where they have a chart where I can superimpose price and implied volatility or historic volatility sitting there, and I can see that difference, and it's really handy. And it has OptionVue provides tools on that costs on an annual basis less than what some of my friends pay on a monthly basis, and I would not use their tool because it doesn't have any benefit over OptionVue, because OptionVue allows me to see things the way I like to see them. And somebody said it is because of that. So yeah, it's the square root sort of 252. It's actually the square root of 256, if I remember correctly. But yeah, it's 196 plus 96, or 160 plus 96. So yes, geez, what a nice little bit of information to get. I'm glad. Thank you to everybody that allowed me to add this to the verbal description. So let's look at the current volatility levels. And I'm going to talk about the indexes. They're at historical lows, implied and historical and statistical volatility in almost all the indexes and in many of the stocks. And people say it's too low, or it's too high, or it's too this, as if there's a right or wrong. It's a consensus based on where options are trading. But it is, you know, one of our presidents once said it defines, it matters how you find what is. And so the volatility levels are, or a volatility level is. It is what it is, okay? Some people consider implied volatility, the option volatility, to be forward-looking. And it is forward-looking when it comes to earnings announcements. And that's or any other volatility event. Okay. And so, and once again, I'm going, what if, what if, what if? It's where I am. Just so know and understand your position, okay? Know and this includes know and understand your P&L. Know where it's coming from. How much of it is based on the movement of price of the underlying? How much comes from the inexorable march of time? How much comes from changes in implied volatility? Okay? And know your Greeks. Most people that I teach and work with understand delta very well. About 30% are iffy about gamma. And then when we start talking about Vega, they have problems. And to be quite honest, when I first started trading, I had problems with Vega. I didn't even get Vega on a daily basis. I got delta, gamma, and theta. And that's it. And I got it once a day in the morning when I started trading. I had a pretty good, in my head, I could basically figure out what delta was. I got to be pretty good at that. And then we ended up with handheld computers that could help us. There was PC Quote and other pieces of software that allowed us to do that. Okay, but start learning, understand the impact of Vega implied volatility on options in your position. You will become a much, much better trader. And don't skimp on tools. I mean, gosh, I hear people complain about, this tool's too expensive, that tool's too expensive. I guarantee that there's multiple times a year where I recoup the annual cost of OptionVue because it's easy to use, easy to read, and reduces my risk to a lowest common denominator. And once again, what if? Know the impact, daily impact of changes in price and time and in my volatility on your position. And finally, have an idea of what you're going to do when the price of the underlying moves, or when you're going to get out of a position. I get out of my positions, I'm out of it by about 35 days before expiration. My front month, any option that has 35 days or less, I'm actively working to get out of. So that's basically it. I have lots of answers for any questions you have. It might be, I don't know, but I have answers. Thank you very much.
Okay. Thanks so much, Frank.
Thanks
a
you,
lot,
Steve.
Yeah, nice job. So on my side, I don't see any other questions. Do you?
No, I don't.
Okay.
But I like it when I'm taught new things, and 16 days being the square root of 256 and how we calculate standard deviations, etc. I think this is, something I'm going to teach myself now. Maybe I'll do one of our little TED presentations on this. Probably 15 minutes would be more than enough. So thank you.
All right, everyone. Thanks so much for joining us, Frank. Thanks a lot. Take care. We'll talk to you next week. Bye-bye.